Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, May 29th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro events are bad treasury auctions, range-bound markets, and commodity outperformance. In terms of market implications, yesterday's auctions of 2-year and 5-year treasury notes drew tepid demand amid the persistence of our resilient U.S. economy and sticky inflation themes. The projected increases in coupon supply and TGA through Q3 are likely to continue to prevent bond yields from breaking down on a sustained basis. On the flip side, the hyperfinancialization of the U.S. economy and likely accelerated shelter disinflation are likely to prevent bond yields from breaching the 5% level observed last fall, thus contributing to a potential range-bound trading across asset markets this summer. Investors looking to build core positions that can survive this business cycle should look to commodities and commodity producers. There will be no AI boom without significant physical infrastructure investment. Transitioning to our 42 macro dashboard here. As always, a wrap up with a question from our community. This one's regarding the rally in utilities. It says, hi, Darius. XLU is bullish in the inflation regime. Is the recent utilities rally a leading indicator of a row phase transition to a inflation regime? So just a quick background for those who may not be familiar. Row phase transition just means you're going from a risk on regime to a risk off regime, or vice versa. We are currently in risk on reflation, and the question is about a potential phase transition to a row phase transition to a risk off inflation market regime. In our nomenclature, Goldilocks and reflation are the two risk on regimes. Goldilocks being risk on with a disinflationary bias, reflation being risk on with an inflationary bias, and then inflation and deflation are the two risk off regimes. Inflation is risk off with an inflationary bias, and deflation is risk off with a disinflationary bias. So the question is regarding the recent outperformance of utilities as a potential leading indicator from reflation to inflation. And so the answer there is it very well could be that, certainly we want to predict the predictors. We just want to let the compendium of signals pull our market regime nowcasting process into the proper regime so that we can reposition our portfolios so that we can maximize upside capture, or in this case, we'd be minimizing downside capture in a potential correction if you're going to inflation from reflation to inflation. But the one thing I would also say is that, people are playing utilities as a derivative play on the AI theme, in so much as they're playing pockets of the commodity markets, namely copper, some of the industrial metals, as well as uranium. So if utilities are now getting this sort of pro-cyclical AI investment bid, then they may be less defensive in a risk-off market regime than they otherwise would be. I'm not smart enough to know the answer to that. I don't think anybody knows the answer to that really, but we'll find out if and when we do, in fact, complete a row phase transition. So we'll wrap it up there. Darius Dale presenting our macro minute for Wednesday, May 29th, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.